You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, you know what that music means. It's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com. as well as from the ever-expanding Options Insider Radio Network. 13 programs for you guys to choose from on said network, including all of the amazing archived episodes of this program, Volatility Views. And you can find them, of course, wherever you find your favorite podcast programs, including our site, the mothership, theoptionsinsider.com. You can find all of our 8 years now, 8 years in January, 8 years worth of content on the Options Insider Radio Network, as well as iTunes, Stitcher, Aha Mobile, all of the usual suspects. And we were off for the past few weeks, but now we're back, and we're really excited to be reviewing some volatility and viewing it once again. I am joined, as usual, by my usual cohorts, my usual partners in crime on the old Volatility Views panel. Starting off with the major domo of all things derivative over there at BGC Partners, Mr. Jared Woodard. Jared, Happy New Year to you, and welcome back to the Volatility Views program.
Happy New Year. Thanks. I'm glad to be with you. You can probably hear in the background we're having a really big time today.
Sounds like a party going on at BGC.
Yeah, you sound like you're talking on PA.
You know how on TV they're always talking about buy the VIX, sell the VIX. Someone just figured out how to do that. So I'm just kidding.
Good stuff. Well, maybe after the show, I'll get invited to the BGC party and I'll fly over there. Sounds like a good time being had at the BGC studios there. All right. And also joining us, you just heard him a second ago, Mr. Mark Sebastian from OptionPit.com. Mark, welcome back to the show and Happy New Year to you as well.
Happy New Year, Mark. It is good to be around. It is good to be alive. It is good to be around in 2015.
It sounds so futuristic, doesn't it? 2015. It sounds like we should all be flying spaceships and having our robot butlers.
I know. Wasn't that the year that really cruddy Disney movie, The Black Hole, took place in?
And I know it was Back to the Future. I don't know if it was a Black Hole as well. If it was, and it was a double whammy of poor portraits of the future. All right, but speaking of poor portraits, we don't have that in store for you today. We thought, what better way to kick off the new year than to bring back one of our favorite guests on the old Volatility Views program. So we've done just that. Let's dive right on into our Volatility Viewpoint segment.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, everybody, welcome to the Volatility Viewpoint segment. You guys know the drill by now. This is indeed the portion of the program where we welcome on guests from throughout the world of volatility and volatility trading and analysis and research, and we proceed to pick their brains for the benefit of you, the listener. And we thought, what better way to kick off 2015 than with the return of one of our favorite guests. He is Euan Sinclair, the risk manager over there at Bluefin Trading and the author of numerous volatility tomes, including Volatility Trading, Editions 1 and 2, as well as Options Trading. You might have some more forthcoming as well. Euan, welcome back to the program. It has been too long.
Well, thanks for having me back. Honestly, I don't sound like I'm doing as well as the last two people. I mean, I don't have a party in my office, and I mean, it's sitting here in the snow in Chicago is not quite as exciting.
Just blow off a few of your leftover noise buzzers from New Year's, and it'll sound like you have a party going over there as well.
Yeah, that's true.
Well, Euan, we just did on our last episode a few weeks back kind of our own look back at the year that was for 2014, kind of our major thoughts, our major takeaways from a volatility perspective as we look back on the year. So I thought we'd start off the year here, giving you the opportunity to do the same thing. As you look back on the year that was from a vol perspective of 2014, what are some of the major lessons you took from it? What are some of the major takeaways that come to mind for you when you think back on 2014?
Well, I think there's been this fairly persistent idea amongst, the chattering class of traders that volatility is very low and the VIX is low and there's something that we're missing. And I mean, there's always something that we're missing, right? No one can see the future. But I think we have to sort of see, if you look at the VIX since 1990 at its inception, the median value of the VIX is about 19. But if you look at the VIX over the last 4 years, the median value is around 14. So I think after 4 years, you've got to kind of say this is the new normal. This is sort of where we are. So I don't see from that regard that volatility has been particularly anything special over the last year. I think the thing that's been more interesting to me is that we used to always say volatility spiked up and then fluttered down. Recently, volatility has been spiking up and then spiking down. So I would say volatility is probably roughly fairly priced right now, but certainly we've been seeing more spikes both directions.
And you brought up two interesting points there that I want to hit on. The first was, you're right, that kind of oft-repeated phrase, and we've discussed that, as you might imagine, quite a bit on the show in 2014, particularly when that VIX media spike was getting really hot and heavy. The VIX was too low, and you're right, people were abandoning about that 19 level. That's quite a bit. It has to revert back to that 19 level. And yet you're right, when you look at the actual data, nearer term, it's a much lower number. And so people tend to overlook that. And that's a point we make on this show quite a bit. But the other point you make is actually a very good one I was going to ask you again anyway. So I think you and I are on the same page when it comes to this stuff. We saw towards the end of 2014, like you just alluded to, a pretty sharp increase in the vol of vol out there in the marketplace. We saw, VIX and implied vol really starting to swing very aggressively towards the end of the year. And I have my own thoughts on what the drivers of that were, but I'm curious what you think were really the big drivers of that increase of vol that we saw, particularly toward the end of 2014.
I'm assuming you mean October, where the VIX really spiked?
That's kind of where it kicked off. Yeah, definitely.
Yeah, the volatility of VIX went from, the implied vol, from a sort of reasonably steady level of about 60 to about 120, which is almost crash levels. And I don't know why it did that, and I'm not sure any of the VIX traders really know why it did that as well. It seemed to be sort of just building on itself. But we've seen this in the past, that, for example, when there was the fiscal cliff issues and Congress were refusing to do anything. Well, I mean, they still refuse to do anything, but it's less crucial right now. We saw these spikes, but this particular one seemed to be more of an endogenous market sort of thing rather than an exogenous thing, like in a response to news. So I'm a little mystified as well, to be honest. Although I think it's interesting, it's not so much just the volatility of the VIX that's spiked, it's the downside volatility of the VIX. The VIX down moves are now really fairly dramatic. If you look at that move in October, the down moves were about as big as the up moves.
Yeah, you're right. It was very dramatic. And of course, you're talking about the vol of VIX, which is measured in that VVIX index. Talk about that a lot here on the show. And you're right, it spiked up to, I believe it got near the 140, at 141 and back in latter part of the year in December, actually it was. So it was some crazy movement in that index. It's then sold off. It rallied again and now has sold off yet again. So it's been interesting to watch that VVIX. Now, Euan, I'm trying to think the last time you and I ran into each other, I think it was at the big global derivatives conference here in town a few months back. And I know a big topic of conversation at that event was what people were at least intuiting was a relative diminishing of liquidity in a lot of the institutional products as a result of some of the things we've seen coming out of Dodd-Frank and others. They've been stripping a lot of the prop desks out of the big banks. And so a lot of the products that are institutionally oriented usually have a lot of big institutional players are perhaps having fewer players at the tiller these days. And that was one reason people were bandying about for perhaps starting to see the increasing severity of these swings and this increasing vol. And if that's the case, it probably will be the case going forward. I'm curious, you were at that same event. What's your take on that maybe structural issue? Do you think it's as severe as people are making it out? Is it one of the big drivers for this, or you think it's kind of overplayed and there's other things really at work that are causing this increased vol that we're seeing and these more dramatic spikes that you alluded to?
Well, the story as it goes is true. I mean, the institutional desks have been getting shut down. The banks are warehousing a lot less risk. And they're feeding stuff much more directly into the market makers than they were. And also the number of market makers, although market makers are probably as a whole capitalized better than they used to be, because there are bigger ones, there are far fewer ones as well. So you still have a small number of people taking down all this risk. So that's absolutely true. How that feeds into the volatility of volatility, I think is just pure speculation. I think it would be very difficult to measure that to really know. It's a plausible story, but people like stories, and I'm kind of like to see the numbers before I believe the story too much.
Okay, Euan, this is Mark Sebastian speaking. It's great to speak to you. Do you have any thoughts on how other worldwide volatility and commodity volatilities are, the effect they're having on VIX and the equity markets? I don't know if you've taken a look at OIV, which is the option volatility in WTI, but it's been consistently above 40 for now almost almost a month, and is basically trading similar to how the VIX traded in like 2011. Do you have any thoughts on some of the commodity vols and maybe some of the currency vols?
Yeah, when you first started posing that question, my initial thought was going to be no, but the elephant in the room is clearly oil. I've got I was going to say proprietary, but that makes it sound much fancier than it is, a way of combining the implied volatilities of maybe 4 or 5 different things that I think are important, looking for panics. Because panics and crashes really happen over the entire space of volatility rather than just, say, indices. So I look at bonds, I look at oil, I look at Europe, I look at the dollar, I look at Japan, I look at emerging markets. Right now, the only thing I see that is crazy, and I think, honestly, the only commodity that is really important in the world is oil. Oil is... how do I put this? When oil went up originally, maybe in 2007, 2006, 2008,
yeah,
all you heard in the chattering classes of CNBC, granted, not the smartest guys in the room, but they're the loudest guys in the room, was how this was terrible for the economy. And now oil's come down again to 50, and it's terrible for the economy as well. I don't really understand that. I think this is a great thing for the American consumer and, frankly, the Chinese consumer as well. I think this is going to really help. It's like an enormous tax break for everyone in the world. I think this is really going to help anything that is tied to consumer spending. Having said that, looking at oil, the oil volatility is crazy right now. It's risen, just looking right now, from around 15 to 47, 50 kind of level.
Yeah, it touched over 60 earlier at the end of last week. or earlier this week, excuse me.
I mean, to me, and this might be just my bias in the world in general, it looks like a crazy sale right now. Typically, oil coming down means volatility is going to come down. I don't know what's going on in that market to drive these vols so high. And, I mean, to be fair, realized vol's been high as well, but it doesn't look to be justifying these levels at all. But I don't see anything else going crazy. It's like the bonds aren't going crazy, Japan's not, Europe's not, the dollar's not. So I think it really just tells me that oil is probably a pretty good sale in the vol space right now.
Well, that's certainly a topic we've been discussing quite a bit here on the show, and we mentioned, particularly in the early part of the oil move when it was still hovering in the mid to low 80s, and people were starting to bid up these puts 60 handle and south like they were going out of style. We kind of all thought that was a little bit overdone. Perhaps certainly in retrospect, some of those did better than we initially anticipated. But you're right, now we're still seeing a decent hefty premium to those puts, less so than it was clearly, and some renewed interest in the call side of the skew, which is kind of a newer phenomenon over the past few weeks to a month. But still, it has been interesting to watch, and you're right. Certainly, those put levels have been pretty crazy inflated over there. Mr. Jared, I know in addition to celebrating that wild party over there at BGC Partners, anything you want to throw in here for Mr. Euan?
Yeah, I think I think that there's a great analysis of the lay of the land. It's thinking in terms of the commentary and reception in the markets of this move. It's just kind of highlighted to me the eternal importance of some fundamental knowledge and economic analysis, and how irreplaceable that is in a world where so many other participants seem to be driven sometimes by charts and lines on charts and patterns that they think they perceive. I mean, if you understand why something's happening from an economic point of view, obviously the market can, momentum can overshoot in either direction. But in terms of, understanding what's really going on, this move in oil is unquestionably about the supply issues that we're all familiar with by now. And especially with regard to the U.S. economy, I mean, our economy is so closed. Exports and trade just overall is such a small percentage of GDP. We're driven by domestic consumption, and it's just unquestionably the case that not only that this move in oil is fantastic for the consumer, but also that worries about capex and the effect of unemployment effects from any job losses in the energy sector, I think are undoubtedly going to be dwarfed by the positive benefits to demand. And so while this isn't, an inflationary pressure from any kind of large upside, it's definitely not a deflationary risk, and I think that the Fed has perceived that properly, and they've been trying to communicate that in a moderate way in recent speeches. So in that respect, I think that the analysis of the level of oil vol is something that shorts who got burned in the last quarter maybe were too aggressive or too early. I think we could still expect folks to take another stab at that just as soon as the trend starts to slow.
I would also add to that, which I agree with completely, this has kind of taken some of the geopolitical risk out of the market as well. I think recently people have been mainly worried about Russia and the idea of a new Cold War. I mean, this oil downward pressure is going to absolutely kill Russia. So for possibly the first time in their history, the Saudis are really doing the world a massive favor in the foreign policy sphere.
That is absolutely true. It's interesting. I keep waiting. I'm going to know that we're starting to really get toward the end of this big oil sell-off when I start seeing deals start to take place as some of the big producers step in. I'd like to circle back to kind of the overall markets. Now there are 45 or 50 option markets right now, something like that, 75,000.
I think you're a little low.
There's somewhere in the range of 800,000 to 900,000 options exchanges now. What are your thoughts on how fragmentation and really what I would call a cone of liquidity, where we have almost unbelievable instantaneous liquidity in the front month and in the near term options, and almost no liquidity in options with 3, 6, and 9 months to expire, or a year, what effect does that have on things like the variance market and on on the volatility of volatility, and in general kind of how the overall markets are going to work going forward?
Wow. I don't really want to speculate on that because it would entirely be speculation. I think overall this has been a benefit for anyone who isn't a market maker. The problem with the market makers, or the problem the market makers have, isn't so much that the spreads have come down. The problem is that every time a new exchange turns up, it's an extra drain on infrastructure getting connected to it and writing the right protocols and getting tested and so forth. But to anyone who's trading positionally, I think this is a good thing. I think most people would dramatically overestimate the amount of liquidity in the options market anyway. And I think they always have. I think, 3,800 stocks in America are optionable, something like that. But realistically, you can only trade about 200 of them. And the ones with any liquidity tend to be the high vol sort of name stocks. Like I know I'm not looking up on the screen right now, so I could be wrong. But if you try and sell some options in Johnson & Johnson, which is a major company, I think you'll find the spreads are enormous. Mm-hmm. So I think people have always overestimated the amount of liquidity in options.
Euan, I want to dial it back a bit to another topic. That was a great question, Marcus. We could probably spend a half an hour just talking about that. But dialing it back to the broad equity vol for a second, I was thinking about the last time you and I were chatting, and we had a conversation about kind of the counterintuitive nature of VIX and VIX trading, and how when people were out there beating that drum aggressively for VIX is too low, VIX is too low, there still was a demonstrable risk premium in the market of implied versus realized of somewhere between 5 and 6 points. So it still was a worthwhile sale, and perhaps a very good sale at that point. And on the flip side of it, when VIX is gapping up, that might be the time people start thinking maybe you want to sell at that moment, but actually maybe the point when you maybe actually want to start thinking about buying at that point, because that's when the probability of really blowing through strikes to the upside and really getting run over is the highest. And it's funny, after we had that conversation, I tweeted that out there to our audience, and let's just say I got a healthy amount of skepticism in return. I don't think they really understood the concept. So why don't you do me a favor and walk our listeners through your thought process on that and what you were thinking about in terms of selling low VIX and buying the high VIX?
Yeah, this is an interesting story. This is one of those things I completely and utterly believed when I said it. I wasn't trying to lead anyone astray. On the other hand, someone else asked me about that, and they asked if I'd write up a little article about it. And so I went back and I started looking at some numbers, and it wasn't quite as conclusive as I thought it was. Let's put it that way. Overall, I'm right, but I'm not as right as I thought I was, and I think there's more going on than I originally thought. But anyway, what I would say is just because something's cheap doesn't always mean it's too cheap. And I think generally, when the VIX is low, options are a good sale. I think when they're low, they're not low enough. And conversely, when they're high, they're not high enough. So I think the tendency of people when they know they have something that's broadly mean reverting is to look to buy low and sell high. And I think when it comes to implied volatility, you're better off leaning the other way.
Yeah, I've often said that, it's not, people don't blow out in low vol and people really don't blow out in high vol. It's the transition of low to high or high to low that really blows people out. One of the things, one of the big indicators that's being put out there is, and Mark, I commented on this, is, a lot of people like to look at how VIX and VXV are trading against each other. So 30-day vol versus 90-day vol. And they use that as a go long indicator when the two cross. And to your point, that actually has, if you go back, over really a 25-year period, a large enough period to have a real data set, that actually has a negative expectancy because, yes, most of the time when near-term vol and, kind of eclipses long-term vol, the market does mean revert back to whence it came. But when it makes those major transitions, it really makes those transitions incredibly hard to the point where it could absolutely blow people up. And so to your point, when vol is high, it's probably, I agree with you. When vol is high, it's probably not high enough. And when vol is low, it's probably not low enough.
Yeah, I just want to make a point here about that. It's, I would agree with you. It's not an absolute perfect predictor of anything. On the other hand, I think it was a very interesting point when it first came along. And it's a friend of mine, an Austrian computer scientist, actually, called Christoph Donninger, who I believe was the first person to come up with this formulation of it, although there's also a paper by Simon and Campasso a few years later, which did something similar with the VIX basis, which essentially is just the short part of the futures curve. Okay, so generally that is a good idea, but the long part of it still loses money. So when you go long, you're probably still going to lose money. I think it's more useful as the idea tells you when to go short and when it is safe to be short. So I certainly use that, and from work I did with Christoph, maybe 5 years ago, just as a risk management tool, I use it as a way of when it's kind of like safe to get back in the water. But it certainly isn't. It's not the free money people think. And yeah, you're right. It's the transition periods are particularly hard because you tend to lose a lot of money flipping because it's those days when you're meant to go from short to long. It's probably one where the VIX is having a 20% range, and it's kind of tough to get in on a good level on that one.
Yeah, I want to jump in on this theme because I've got an idea that I'm interested to get you and everyone's take on, really. But so since we're talking about the value and the value of the signal and changes in term structure of implied vol, one thing that I've noticed in the last year or two is how different points along the curve, and we can talk in terms of ratios or whatever comparison we want, and how those different areas of the curve, whether it's VIX futures or S&P implied vol, have reacted differently over time. So what I mean is, one very popular thing to do, as Sebastian just mentioned, is looking at ratio of 1 and 3 month VIX. You can also look at 3 and 6 month or 3 and 12 month or any kind of different points in time. You could do other more sophisticated things with the curve, and a lot of this is just replicating things that fixed income traders do with yield curves. And what I've noticed is that the profitability of different fixed by time, constant maturity type products, XIV and ZIV are ticker symbols for two short vol products that we're all probably familiar with. Those have performed differently over time as different parts of the curve react differently into the market. And so even netting out the value of long, short in the market from changes in that implied vol curve, there's been different reactions within the curve to so different levels of maturity that have behaved in different ways over time. And my thought in this long rambling thing that is actually a question is whether the composition of the market has changed for trading vol, whether there's been not just an influx of individual investors and investment advisors who are starting to take this seriously, but even at the level of the kinds of hedge funds and asset managers and larger players who might not have been active in this part of the market, say 10 years ago, and whether that's possibly driving some of the changes in the reactivity at different points of maturity that we've seen in the curve. I guess it's I have my sense of what the answer is to that, but I'm curious to hear what you all think first.
Euan, go ahead.
I was hoping someone else would dive in here first.
You get pride of place today.
Well, yeah. How do I? Okay. I think the composition of the market has changed. I think it went through a period, maybe since 2008, where the banks were closing down their prop desks, but the people who were trading on the prop desks hadn't had a chance to set up other operations. And that has definitely had a chance to play out. And there are now more dedicated volatility funds and operations than there used to be. There are also more volatility ETFs, or ETNs, that have a way of feeding back into the market than there used to be. And funds that do exist now tend to be bigger. Getting a prime brokerage relationship now is much, much more difficult than it was even a year ago. The banks are tidying up their balance sheets as well, aggressively. I think the composition of the market's absolutely changed. I think people are bigger. There's more smart money in the market, in the volatility space, possibly not than there was 10 years ago, but more than there was 5 years ago. I think also these kind of signals, if you look at them over 20 years, they appear to have done very well, but on any given year, they tend to be relatively noisy. My own little sort of combination of these signals only has a Sharpe ratio of around 1.25. So, on any given year, there's a lot of noise in that. And sometimes I like things that I believe in to be just noisy enough to give other people doubts. Because if something works all the time, then once people notice it, it's going to stop working at all. So I'm okay with that, but I think you're probably right.
Euan, one of the things I wanted to get your opinion on as well has been a common topic of discussion for us here on the program, certainly over the past year. That has indeed been the rise of interest in everything short duration, everything short term, particularly short term volatility. That's been a big interest factor. We saw VIX getting recalculated to add some weeklies into the mix to smooth it out a little bit. And of course, earlier last year, we saw the much ballyhooed launch of the first real short term VIX product, VXST. Ever since then, it's kind of been a bit of a head scratcher as to what's going on with that product. It kind of took a long time to gain any traction, seemed to be doing all right from a ADV and from an open interest perspective. And then going into the new year, and the end of last year and into the new year this year, it's kind of just fallen off a cliff yet again. In fact, I think in a week when the market certainly wasn't quiet, and certainly when there was certainly some vol being exhibited in the marketplace, we saw VXST having days with zero contract volume, I believe, or very close to it, and in very few days actually breaking. Yes, on Wednesday, I believe we did zero contracts in VXST, and the rest of the week it didn't even break 100, 50, 60, 12. It's been, let's just say, a bit of a disaster week from an overall VXST perspective. As someone who's been around the vol space for a while, what's your take on this product, and why do you think it has failed to really resonate with either the institutional or the retail crowd? No one seems to want to touch this thing.
I'm going to come up with 3 reasons. The first one's like a market structure issue. I think for a start, it took the VIX a long time to take off. I mean, if you look at volumes in the VIX, they were very, very low for a long time, and then they sort of increased exponentially. And also, I think the VIX volume really started taking off when there were ETNs listed on it. And so you get the ETNs become big users of the VIX futures. And also there are feedback effects, and people can trade the futures against the ETNs and things like that. And as far as I know, there's no VXST ETN right now. Is that right? I think that's right. The second issue, I think, is that the really short-term vol is almost just at the level of noise. I don't think there's really much in the way of real signal to it. For example, the VXV versus VIX has a signal. I mean, that means something. VIX against VXST, it doesn't seem to. It just seems to be kind of random. I mean, there's a bit of a positive signal, but it's nothing you get excited about. And the other thing, honestly, is, look, I like the CBOE. I like the people I deal with there. I think they're smart. I think they're professional. But they've really had one good idea over the last 10 years, and that was a great idea, the VIX. But the other stuff they've tried to sort of build on around that hasn't really worked. I think the VXST is kind of one of those things. It doesn't appear really... Seems like the VIX threw it out. I mean, the CBOE threw it out there because they hoped it would work, but it just doesn't look like it's going to.
And I'll be honest, I was a little surprised because where I thought this had some value, Euan, is I thought it would be finally a way to really isolate an S&P 500 option into just gamma, taking the volatility component out into an event. So, where I envision the user would be, somebody goes into the S&P 500 and buys a straddle into something like non-farm payrolls today, and then at the same time they simultaneously sell the future that expires on next Wednesday to take the Vega component out of the trade. That was the way I envisioned the product, and nobody has done anything. It's found no traction as a hedge vehicle at all.
Yeah, I think you might be thinking of this more as a trader than like as an institutional money manager. Because most of those guys don't really want short-term plays. They don't really want gamma. They want things that are a little slower moving, a little more predictable, a little more manageable. I think as a trading product, I mean, to me, this is almost like having, like a daily binary option or something, a purely gambling product or something. And I would be fine with that. I love that stuff. But we're not the guys who really make the market. We're the guys who hang around on the coattails of the guys who do. And I think the genuine users, were any of them really asking for this? Did anyone really want this?
I think they just saw the weekly love and said, hey, we can do that with VIX too. And that's kind of what the origination of it was. And you're right. I don't know if institutional, how much they've embraced weeklies versus the mass of retail. And you're right. And no one seems to have embraced short-term VIX for whatever reason.
No, at all.
I mean, 0 contracts on Wednesday. That's crazy. They've
tried to throw VIX methodology on 900 things, and it continues to, it's a one-trick pony, all right? The reason why that product works is because it's a listed, in my opinion, is that it's a listed product that hedges off an OTC product. So maybe if SIBO was smart enough to look at what else trades over the counter and try and develop something that the banks could lay off, maybe they'd be able to find something else that worked.
Well, I think it has an interesting history the way it started up, right? It's originally the banks there wasn't interest in a variance swap because it's a reasonable hedge against certain states of the world. But the banks weren't interested in letting the variance swap market go onto an exchange. So the VIX came up with this kind of implied volatility variance swap thing, or it's the CBOE did, as a kind of compromise that they'd get away with the banks. And then the variance swap market kind of died because the banks had to sort of cut back on trading those, and the VIX kind of took over. But if you had to start from scratch now, the VIX wouldn't really be the product anyone would want. People want a realized volatility hedge, not an implied volatility hedge. So I think in a lot of ways the CBOE kind of got lucky with the VIX, and now it's like if you win the lottery, you should probably stop, right? You should probably not just keep on buying lottery tickets thinking you have a system.
You're getting a lot of good pearls of wisdom in there, Euan. But you mentioned a realized vol hedge. I'm sure our friends at Voldex are listening, and their ears are burning with excitement right now that you would mention that. Since you're talking about kind of other VIX products, VIX type competitors, we have seen 2 forays into that fray over the past year. One of them we had on the show very recently. Those are the guys doing the Voldex product, which is essentially VIX without the skew, for lack of a better, very, very short explanation there. And then, of course, maybe the more theoretically interesting one, the Whaley one, but actually seems maybe a little bit more esoteric at the same time. I'm curious which of these two, if you had to pick one, do you feel A is the more interesting, is the more what the market needs, and then B, which one do you think actually has a better chance of actually making it in the marketplace?
I'm not really aware of the particular specifications of either of those products. What I think the market really needs is a sort of a realized volatility swap, the way that the Voldex guys were talking about doing it. Just calculate. I mean, it was a very simple idea, right? Just calculate the realized volatility over the last 30 days and call that the settlement price. I think the market could have possibly gone for that if that was the original thing listed. But the VIX now is sort of the thing. And the Voldex guys have had enormous amounts of trouble getting any traction on their product at all. I'm not saying the market has done the sensible thing here, but I think it's kind of spoken. I think the VIX is kind of, for better or worse, what it is now. I don't really know if we need any other volatility product.
Yeah, it's funny. You're right, because what you just outlined is kind of the path every new trader to volatility takes. They discover VIX for a variety of reasons. It's very popular, gets a lot of traction. Then they start trading it, and you're right. They realize that what I actually want is a realized type product or something that performs a little bit better than this. And yet, for whatever reason, the alternatives in that area haven't really seemed to get traction. Well, Euan, we've had you on for quite a while. We'll let you go in a little bit. I just want to go, before we go, this is our first show here of the year. you're our first guest of the year, so you get pride of place. What's in your mind? What are you watching out for in addition to the things we mentioned about oil and others? What's really top of mind for you from a vol perspective going into 2015 here?
Well, I think the other one we've got to really look out for is the bonds. If the Fed starts doing something different, that's going to start changing the market. And I mean, I really like this Fed. I'm a big fan of both the Yellen Fed and the Bernanke Fed, not so much for what they've done, although I don't think they've done anything egregiously wrong, but the way they communicate it is very straightforward. They actually tell you what they're thinking, as opposed to Greenspan, who would, well, you know what his game was. So I think that's an important thing. We have to watch for the Fed. But the overall market, consisting of thousands of companies, I think will begin to fragment more as various sectors start responding to various things like interest rates and oil and so forth differently. So I think there might be more dispersion in the market, but the indices I kind of see more of the same. I think the VIX will sort of settle into a level of around 14 to 15. I think we'll see these more dramatic spikes up and down than we've seen, but I just don't really see anything on the horizon to dramatically change my perspective. I think this year it's going to be kind of like last year.
Certainly is not a unpopular opinion. A lot of people out there sharing that sentiment. Well, before we go, Euan, I know last time I was chatting with you, you mentioned you may be taking another foray into the land of book publishing. Can you give us any hints, any sneak peeks on what you're thinking about for your potentially new book?
I'm currently working on 3 things, which means that the time frame on them is even more uncertain than normal. I'm writing up all my thoughts that I've had on trade sizing, and I don't think there's anything particularly new in that book. It would just be more of a matter of collating a lot of academic research. I assume you know the works of Ralph Vince on trade sizing. I've got a lot of respect for him.
Yeah.
Although I also kind of disagree with a lot of what he said, and also the way he expresses it. His mathematical notation, for a start, is kind of non-standard and a bit confusing. And so I'm writing that. I don't even know if I'll publish it. Like I said, it's more for my own benefit. I'm also doing a very short Kindle book, probably about 100 pages, which I'll sell for over a couple of bucks, on the application of the scientific method to trading. Again, I've sort of started writing now. I write stuff that I like on the assumption that I hope other people will like it as well. And I've always been interested in, I think science is about the only way we can really understand the world. But trading isn't really done in a scientific manner. It's kind of done in an ad hoc manner. And I'm just working through some ideas I have about that. And then I'm working on the big one, which is, how do I put this? I think we understand risk in trading. And I think we really understand that that isn't really what's going on. In war, what's going on is uncertainty, in that risk tells you randomness from a given distribution. You know uncertainty, you don't even know the distribution. But I'm extending that to the idea of ignorance, where you don't really know anything. And I'm working through some ideas on that, but that's probably going to be some sort of pseudo-philosophical nonsense book in the Nassim Taleb genre. And I think as traders get older, they become more philosophical.
Well, pseudo-philosophical books, I think you got Jared's interest now. That's definitely right up his alley. Pseudo-philosophical trading books are pretty much his entire bookshelf.
I keep expecting to write a book called The Philosophical Trader, Jared.
It's coming.
Just merging trading and Zen lifestyle.
Yeah, we can leave the end of the segment with a question if you want to. I was thinking about this yesterday, and I wrote about it a little bit on Twitter. The question was whether, if the weak form of the efficient markets hypothesis is true, just the idea that, the price includes all the relevant information. And let's just assume for the sake of argument that it's also true that the best estimate of the future price of an asset is like the forward, sufficiently, long-dated forward price in the futures market, let's say, to take account of storage costs if it's a commodity or, dividends, et cetera. Okay. If that's the best estimate, then we know what then on an efficient market hypothesis, we know what the best, estimate future price is. Does it follow from that we know what the best estimate of future price is. This is a problem in theories of knowledge and philosophy about whether or not we actually know the things that we know, or do we merely believe them in some weaker sense. And it just occurred to me that maybe if you assume that part of the efficient market hypothesis is true, that it might be actually a counterexample to the idea that we know the things that we know. And so I'll just stop there.
I think you wound him up, Euan. I don't know. I think we're going into a dangerous portion of the show.
What he just said, basically what Jared just said is, it's not what you know or what you don't know, it's what you don't know you don't know. That's what I heard.
We're channeling Donald Rumsfeld here on the program towards the end.
Well, I kind of think I always come back to the Rumsfeld quote. I mean, he got given a lot of flack for that, but I think it was incredibly insightful.
There you go. That's our takeaway quote from the show. Euan Sinclair, big supporter of Donald Rumsfeld, and finds him to be incredibly insightful.
Euan Sinclair and Ted Cruz, they're synonymous. Everybody knows that.
Euan, before we get into any more dangerous territory, we'll let you go. But I want to remind our listeners, if you want to find any of Euan's books, search on Amazon. They're there. It's Euan, E-U-A-N, a little bit of a different spelling, Sinclair, S-I-N-C-L-A-I-R, so you can find his books there. Anywhere else they should go, you and any other sites or any other destinations they should check out? They want to read more about your stuff and some of the articles and things you're working on?
I used to write a lot of stuff for Active Trader magazine, which has sadly folded recently. So if anyone, I think its past issues are still on the web. I've written a lot of sort of, not very technical sort of musings on the market there.
Well, there you go, listeners. No shortage of places for you guys to go out and find Euan's work. I encourage you, if you haven't done so, pick up his books because they are very interesting, and you can get into a lot of the issues we had a time just to touch on very briefly here on the show in a lot more detail. And on behalf of Mark and Jared, Euan, I want to thank you for coming on the show. It was a great way to kick off 2015, and we'll definitely have to bring you back on again down the road to pick your brain a little bit more about all things volatility.
Great. It was great to be on. I hope everyone has a good year, and I hope it's profitable for everyone.
All right, that's all the time we have for the Volatility Viewpoint segment. And unfortunately, or perhaps fortunately, it was a great conversation. That's pretty much all the time we have, except for a really quick little crystal ball segment. So let's get to it without further ado.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, in case you're just joining us for the first time here in our first show in 2015, the Crystal Ball is a portion of the show where, as the name implies, we prognosticate wildly and indeed recklessly about what's going to happen through the week to come from a volatility perspective. We, of course, had non-farms this morning. That seemed to be the only event that was really kind of propping up vol going into the weekend, and that since has happened, and the markets are selling off fairly aggressively, a little bit less aggressively than they were earlier in the session, listeners, so off their lows, but still selling off. VIX seems to be still being a little bit of a languid, not really responding as aggressively as you might think, which is kind of interesting. So maybe we'll start with you, Mr. Sebastian. What's your take on what we're seeing from a vol perspective today and what's coming down the pike next week?
Well, what we're seeing is a slow ramping up of S&P 500 volatility. I think probably into Greece. We're going to continue to see vol somewhat firm. I do think we're trying to find a bottom in oil. One thing I'm noticing, oil's going lower, but volatility in oil options is not going higher. If anything, it's falling a little bit. That was, if you look at oil basically had a 2008 type of event happen over the last couple of months. And, what was really the signal of 2008? Well, the underlying kept falling, but volatility came in at the same time. And I think we're starting to see that in oil. I think that, part of today is really just giving back yesterday's overreaction. We will probably be a little bit calmer next week. But today, right now, is looking at like the only day where we have not moved about 1%. So believe it or not, we're down $15, and that is the least volatile move of the week. And, so I think we'll see a little bit more of that next week. But that's really all I've got.
And Mr. Jared, same for you. What's your take on what we saw a little bit towards the end of this week, as well as what's on tap for next week?
One thing I wrote about this week for my weekly column was the move in VIX over the last several sessions into the year and beginning of this year. It was actually in seasonal terms, it was a new record. If you look at how over any given 5-day period the index rises or falls, looking over the last 10 years anyway, this move in January was the largest on record, and so it was seasonally unusual. I think that traders who expected a strong beginning to the year as a matter of habit were kind of disappointed, and so it kind of fits. It was a kind of a nice way to start a year in which a lot of us, or at least myself, had forecasted not high, but moderate and certainly rising realized and implied vol for the year as all of the different economic factors that we talk so much about start to come to fruition, and you have a recipe for a little bit more turmoil on an occasional basis. That's what we saw recently, and it's unwound. And I don't think we'll see that next week, but I think we'll certainly see this kind of thing more often than not this year.
All right, well said. And unfortunately, we'll have to leave it there. That's all the time we have for the Crystal Ball segment. But really quickly, let's check in with each of my cohorts here on the old Volatility Views panel, see what they have in store for you here in 2015. Mark, perhaps we'll start with you. What's coming down the pike from the land of the pit here in 2015?
We are doing next Saturdays, the 17th, we're doing option trading for stock traders. My goal is that once you see how one can use options, you may never want to trade a stock again. And that's, you may never want to trade or invest in stocks again. And that's my, what the whole point of the event's going to be. It's just $97, but obviously for Insider Radio people, we always give the special code INSIDER to save 20%. So use that code INSIDER to save 20%.
There goes our family clean tag on
No, I said Insider.
But you're right. What is stock? I don't know what you're even talking about, so I'll be curious to take that webinar myself, because stock, what is stock? Mr. Jared, aside from stock, what do you have coming down the pike over there at BGC Partners in 2015?
I have something that just came down the pike. We put out our 2015 outlook this week. It's about 23 pages with a couple different quantitative vol forecast models, some thoughts about economic growth and predictions for U.S. GDP, trade ideas, hedging ideas. There's something in there, I think, for everybody, and I probably won't. I'll probably be sorting through the aftershocks of everything in there for a little bit, but we're all still putting out our regular recurring publications as well, and if folks are interested, they can certainly get in touch.
Well, you can certainly surf over to bgcpartners.com to learn more for yourself. It was a great show today, a great way to kick off 2015. Looking forward to yet another great year of viewing volatility. I want to thank Mark and Jared, as well as, of course, our guest, Euan Sinclair, for joining us. A fantastic conversation. We hope to have many more coming for you in 2015, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.